Welcome to Echo Trade. I'm Jeff Roth, and today we're here with Ted Groesbeck from Groesbeck Investment Management out of New Jersey, and we're going to talk about their growth of income strategy available on Echo Trade. So Ted's got 30 plus experience as an investment analyst and managing portfolios. And so Ted, thanks for being here. Appreciate it. How's it going?
Thank you.
Yeah, so
Thank you.
so let's dive in. I mean, we're here to talk about, you got the strategy on the platform, growth of income. So, I mean, let's start kind of high level about the portfolio. If you can kind of just go over just, a minute about, what's the overarching kind of thesis of the portfolio? What's the philosophy that you guys are kind of tackling within this specific portfolio?
Okay, the portfolio is a growth of income portfolio. How we achieve growth of income is through investment in dividend paying stocks. What we
Mm-hmm.
look for is good quality companies that are paying rising dividends that raise their dividends each and every year. We find that by putting a portfolio together that have very strong companies that increase their portfolios each and every year, this creates a very strong portfolio that does very well in all different market strategies.
Got it. So it's would you call it, I mean, you call it growth of income. So you have, I see the income side with the dividend focused, companies you're investing in, but there's obviously the growth aspect to it as well. So is it kind of, a little bit of both, the focus on the dividend income paying or on the growth of the portfolio at large as well?
Well, we look to achieve dividend growth by investing in companies that have very strong earnings growth. And you'll
Uh-huh.
find that within our portfolio, we have some very large blue chip companies who have relatively stable earnings growth. You also find some other smaller mid cap companies that produce some higher earnings growth, probably on the order of 20 to 30% per annum. So we like to
Mm-hmm.
have a mix of companies of large and smaller mid cap companies that could produce an overall portfolio growth that it would be double digit or better for the overall portfolio. That earnings growth will then translate into dividend growth that will also grow at about a double digit rate that we could expect over the future of, of the portfolio.
Guys, so you're saying you kind of invest in larger companies, they could have growth, but primarily the main purpose maybe is for the dividend yield, and then on the mid cap companies you're kind of looking at growth, and that can turn into dividend yield as well.
Well, yes, the portfolio has a dividend yield of about 2.7%. That's about 1 percentage point higher than the benchmark of the S&P 500.
Hmm.
We invest in some of the higher yield companies. Largely, you'll see some financials. You see a little bit of energy. You'll see real estate investment trusts in our portfolio. These high yield companies, produce strong dividend income, but the growth rates are a little bit slower because these companies just do not grow at very high rates. In other areas, we invest in healthcare, um, consumer cyclicals, and consumer staples to largely provide, again, stable growth, companies where you can have stable income and earnings growth.
Got it. So you talked about some of the sectors you guys are investing in. Are you guys looking at? Are you guys basically sector agnostic, where you'll invest in anything as long as that's looking to support the broader initiative of the portfolio? Or are you guys kind of focused on certain areas, or is it really kind of topical and timely based off of what's happening within the market?
Largely, we have to invest in where the dividends are. So there are
Yeah.
some industries that just don't really have very high dividend yields. So we really aren't in those industries. Strangely, a lot of our competitors sometimes have utilities. We definitely don't really invest in utilities, largely because the dividend growth just is not that fast. That's
Yeah.
why we compare like the real estate sector. We think there's a lot faster growth to be had in some of the sectors within real estate, despite some of what we're hearing about in the office vacancies.
Hmm.
Other areas we like is info tech. We're in some of the larger info tech companies, mainly the chip stocks. They have, very strong dividend growth. We also invest, I guess, in healthcare for some of the safety. So we're in a lot of pharmaceutical companies that have grown substantially over the years and produce very high earnings growth with good dividends, as well as financials and some of the bank stocks as well. So just round out the whole portfolio. These are generally the sectors of the market that generally have some of the best dividend yields and some of the best growth in dividends.
Got it. And so, I mean, with the focus on dividend paying companies and stocks, I mean, that in and of itself, provides, some level of risk protection, because typically they're going to be a little bit, safer of an organization, of a company, that if they're paying those dividends, especially if they're paying high dividends and they're increasing. So is that, in line with your, how you guys, go about managing risk, and how would you guys define the risk of the portfolio relative to other portfolios, and talk about, kind of this typical things that you guys are doing to kind of, in terms of risk management?
Well, the risk to our portfolio is generally that of the stock market. So we are obviously, since we're all invested in stocks and generate the income through our own investment stocks, we don't really have bonds, don't have any
Yeah.
other alternative investments that sort of smooth out portfolios like you might find in some of the more balanced portfolios. But
Yeah.
in ours being equities only, our biggest risk is, of course, what goes on with the stock market. So we're going to be impacted by bear markets, we'll be impacted by down markets, sell-offs. But the portfolio is conservative among stocks, largely because the dividend paying component of it, there's an income component there that shelters it in some of the down market periods by producing stable supply of income. Plus, the stocks tend to be lower beta, so they're not as volatile as the general stock market. So you'll pretty much see that our portfolio does a lot better in down markets where we don't drop as much as the regular stock market in general does. You also find from research on dividend-paying portfolios that they're actually, high return with very low risk, vis-a-vis many other different types of stock equity strategies out there. Largely
Yeah.
just again because of the stability, the more mature nature of the companies, sometimes the more safer aspects of the industries that dividend payers are in, such as
Hmm.
consumer staples, like your grocery companies, some of your other stable companies such as healthcare. People are always going to need healthcare, and they're always going to need consumer products.
Got it. Yeah. So I mean, you're looking at, markets like last year in 2022. You're gonna be impacted by that down market, but you're looking to not be as impacted as much as maybe some other portfolios, or actually outperform a little bit by a few points, versus the S&P, for instance. Is that kind of where you're coming from?
Correct.
Yeah.
What we can also do within the portfolio too is just manage some of the exposures of the different sectors we have. So, for example, in recessions and bear markets, sometimes we can also get more defensive with the portfolio than it already is now. We can certainly move into things such as utilities. We've also moved into companies such as waste management companies, other very stable companies that there's always going to be a need for, no matter what goes on with the economy, and that these companies do pay dividends. Although, granted, the growth rates are going to be a little slower, but they will be a lot safer. You won't see as much of a decline in the stocks for these safer industries.
So that brings a question in terms of kind of, broader performance history. The portfolio that investors see within Echo Trade, the growth of income portfolio, that's brand new for Echo Trade. You're trading your own money in that account, but historically the firm's been around for, I think, about 30 years, and you have a different client base than with Echo Trade. Do you have something that you've been trading on a longer term basis that's similar, at least, to the portfolio within Echo Trade? And if so, can you talk a little bit, broadly speaking, about the performance, on a longer period for that portfolio?
Well, actually, the strategy goes back to the early 1970s, where my father had began working for a foundation where they wanted to generate income and they wanted to do it through bonds. But my father made the suggestion, well, why don't we just try to do the same thing with equities, where we
Yeah.
can get dividend income, plus we get the ability for growth as equities and stock markets do better than
Yeah.
bonds and other long-term forms of investment. So from that strategy, which he managed for decades, and then opened up the firm. We had many other private individuals, a few foundations, and some other people invest in our growth of income strategy. We then expanded that into a wrap portfolio in the 1990s into the 2000s. So we had some very strong business growth through the wrap, through the brokerage house, through many individual clients, through a lot of broker dealer relationships. So the strategy is very good for everybody, whether you are an institution, whether you're a foundation, whether you're a person who's just starting out in investing. You'll be in a very conservative product that will generate income. Because one of the greatest things that you can get from dividend income is the compounding effect of your dividends being reinvested and earning even more return. That's one of the greatest returns in the stock market, comes from dividends. About 40% of the stock market's historical return comes from the dividends and the reinvestment. So for somebody starting out, it's a good way for them to just start building that compounding mechanism that works for them long term. For somebody who's a near retiree, who's probably looking at their investments and saying, well, maybe I'm taking on too much risk. Maybe it's time for me to be a little bit more conservative in my investing, but I certainly don't want to lose out. I think the gains that are going to be there in the stock market in the decades of my retirement years. So it's very good for retirees. So pretty much our product is and strategy is good for almost any individual.
That's great. And so, I mean, can you talk a little bit about, let's go into the investment process and how you guys go about screening companies and how you go about choosing, what's the analysis look like? I mean, your background is as an analyst. So what does that process look like when you choose a company to include in the portfolio?
Correct. The investment team here has a long history of working as analysts on Wall Street, both on the sell side, on the buy side. So a lot of us have had different industry exposures. I myself followed cable and telecoms many years ago when I was an analyst.
Uh-huh.
Many other industries as a generalist, following things such as real estate, following things in logistics, and several other industries. Um, what we could say is what we like to look for in any business is we want to see a good, strong consistency in their revenues. We want to make sure that there's a growing revenue stream. We want to make sure that the company is a good competitor in the industry that it competes in. So we like to see, high and strong market shares along with that growing revenue base. We also want to make sure that there's also consistency in their margins and in their earnings growth, that there's, a steady stream of, growing earnings each year, barring sometimes some periods where, business gets soft or recessions. We also target, again, the dividends to make sure the company's raised its dividend each and every year. So once a lot of those criteria are met, then we just look at, the valuation, where is the stock price now? Is it overvalued, undervalued? Is it looking at a technical basis? A good time to get into it. So we look at those criterion as well before we make our investment. And as long as the company, meets all of those criterions, is in a strong industry, then we will probably make an investment in the company. Usually our investments are about 3%. So we tend to hold a portfolio of about 25 to 30 companies. So we
Mm-hmm.
make sure that there's, no too high of an exposure in any particular company or in too much of one industry. Again, we're pretty much overweighted towards the industries that pay their dividends, underweight to some of the industries that are at least no dividends or have slower growing dividends. We also like to look at cash flow to make sure the companies have very strong cash flow, since that's what ultimately pays the dividend. So we look for all of those qualities and put together a portfolio of companies that meet all that criterion.
So that's fantastic, man. I guess we could, to wrap it up, just I'll kind of, leave the last word to you in terms of just talking about really quickly, obviously this portfolio, really the thought process behind it sounds like it's been around, been worked on by yourself and your father for about 50 years almost. But why this portfolio for Echo Trade, and kind of what do you think makes this different than maybe other portfolios within Echo Trade and within the industry as a whole?
Well, again, like I said, largely the consistency of it. It's a strategy that is always the same. It's time tested. There are many other
Yeah.
people like us that invest in dividend paying strategies. I think the greater thing for us is that we also make sure that we are investing in companies that grow their dividends, whereas some dividend investors just buy companies that just pay flat dividends just to generate income, or they just go into high equity yields, which can be risky, or they just buy preferred stocks that just pay a flat dividend and act more like bonds, and you don't really get the appreciation. So I think for our strategy, again, it's time tested. The returns are very consistent. They've been very strong long term. They may not beat the market, but that's not our game. We're not out to try to beat the market each and every year. We just want to make sure that we can put together consistent returns that can make an investor wealthier and move forward in the future at the end of the day.
That's great. Well, hey, Ted, I really appreciate you being here. Investors can check out the growth of income portfolio within Echo Trade. And thanks for partnering with us, Ted.
Okay, thank you.